Well, I get asked all the time, Warren, how do you decide what to buy? People think there's some secret formula locked away in Omaha, or that you need a team of analysts with fancy spreadsheets. The truth is much simpler than that, and that's what I want to share with you today. After more than 70 years of buying businesses and stocks, I've learned that you really only need to look at 3 numbers, just 3. Now, Wall Street would love for you to believe it's complicated. They want you watching screens, reading research reports, chasing the latest trends. But Charlie Munger and I have always believed that investing should be simple enough to explain to your neighbor over the fence. Let me tell you a quick story. Back in 1988, I bought my first shares of Coca-Cola. Now, everyone told me I was crazy. The stock had already gone up. The market was expensive. There were all these fancy new beverage companies coming along. But I sat down at my kitchen table, looked at 3 numbers, and I knew this was a wonderful business at a fair price. That investment is now worth more than $20 billion for Berkshire Hathaway. Same 3 numbers every single time. Now, before I share these numbers with you, let me be clear about something. I'm not the smartest guy in the room. Never have been. I'm 94 years old. I eat McDonald's for breakfast. I drink 5 Cokes a day. And I live in the same house I bought in 1958 for $31,500. You don't need to be a genius to invest well. You need to be disciplined. You need to be patient. And you need to focus on what matters. So let's get into it. The 3 numbers I check before buying any stock. And I promise you, by the end of this, you'll understand exactly how to apply this yourself. Number 1, return on equity. Now, that sounds fancy, but let me put it in plain English. Return on equity, or ROE, tells you how good a business is at making money with the money shareholders have already put in. Think of it this way. Imagine you and your neighbor decide to open a hamburger stand. You each put in $10,000. That's your equity, your ownership stake. Now, at the end of the year, your hamburger stand makes $4,000 in profit. You've got $20,000 of equity. You made $4,000. That's a 20% return on equity. 20% return on equity means for every dollar you've invested in the business, you're getting 20 cents back in profit every single year. Now, here's why this number matters so much. If a company consistently earns high returns on equity year after year after year, that tells you something profound. It tells you this business has what I call an economic moat. It's got some kind of competitive advantage, some protection that keeps competitors from eating away at those profits. Maybe it's a brand that people love, like Coca-Cola or Apple. Maybe it's a network effect where the product gets more valuable as more people use it. Maybe it's low-cost production that nobody can match. Whatever it is, high return on equity sustained over time is the fingerprint of a wonderful business. When I look at a company, I want to see return on equity consistently above 15%, preferably 20% or higher. And I want to see that not just for 1 year, but for 10 years, 15 years, 20 years. That's the test. Let me give you a real example. See's Candies, a company Berkshire bought back in 1972 for $25 million. People thought we overpaid. But I looked at the return on equity, and it was north of 30%. Year after year, this little candy company would take the money we left in the business and turn it into more money, reliably, predictably. Over the years, See's Candies has made us nearly $2 billion in pre-tax earnings. From a $25 million investment, that's the power of high return on equity compounding over decades. Now contrast that with a business that earns, say, 5 or 6% on equity. You're barely keeping up with inflation. You're not creating real value. And usually those low returns mean the business is in a commodity industry where anybody can compete, where there's no moat, no protection. Those are the businesses I avoid. You can find return on equity in any stock screener, any financial website. It's public information. But most investors never look at it. They're too busy watching the stock price bounce around. The stock price tells you what other people think. Return on equity tells you what the business actually does. Number 2, debt to equity ratio. This one's about safety. It's about making sure you don't lose money. Remember, rule number 1, never lose money. Rule number 2, never forget rule number 1. Debt to equity ratio tells you how much debt a company is carrying relative to the equity, the actual ownership value. Let me go back to that hamburger stand. You and your neighbor Put in 10,000 each, 20,000 total equity. Now let's say you borrow another 20,000 from the bank to expand. You've got 20,000 in debt, 20,000 a debt to equity ratio of 1-to-1 or 100%. Now here's the thing about debt. Debt is a double-edged sword. When times are good, debt can amplify your returns. You're using borrowed money to make more money. But when times get tough, when sales drop, when the economy stumbles, debt can kill you. Because debt doesn't care if your business is struggling. The bank wants its money back regardless. I've seen so many good businesses destroyed by too much debt. Companies that could have survived a recession, could have weathered a storm, but they had so much debt piled up that when cash flow slowed down, they couldn't make the payments. They went bankrupt. Shareholders got wiped out. So when I look at a business, I want to see a debt to equity ratio that's manageable. For most companies, I like to see it below 50%, ideally lower. Now, there are exceptions. Banks and financial companies, they operate differently. They're in the business of borrowing and lending. But for a typical operating company, a manufacturer, a retailer, a tech company, low debt means you've got a margin of safety. Let me tell you about one of my biggest mistakes. In the 1960s, I bought Berkshire Hathaway. It was a textile mill, and it was cheap. Boy, was it cheap, but it was a terrible business. The textile industry was dying. There was no competitive advantage, and the company was struggling under debt. I thought I could turn it around. I was wrong. I wasted years and millions of dollars trying to save a business that should have been shut down. That experience taught me something invaluable. A mediocre business with debt is a disaster waiting to happen. A wonderful business with little or no debt is a fortress. Think about Apple. When we started buying Apple back in 2016, people said, "Warren, you don't understand technology." Maybe they were right, but I understood the business. And one thing I loved was that Apple had very manageable debt relative to its equity and its cash flow. In fact, Apple was sitting on a mountain of cash. That's the kind of balance sheet that lets you sleep well at night. When you're looking at stocks, pull up the balance sheet, look at total debt, look at shareholders' equity, do the simple division. If the debt to equity ratio is over 100%, be very careful. Ask yourself, can this company handle a downturn? What happens if sales drop by 20 or 30%? Will they be able to pay their bills? If the answer is no, walk away. There are plenty of other opportunities. Don't take unnecessary risk. Number 3, price to earnings ratio, or as I like to call it, what you pay versus what you get. This is the number that tells you whether a stock is cheap, expensive, or fairly priced. Now, let me be clear, price matters. I don't care how wonderful a business is. If you overpay, you're going to get poor returns. Price is what you pay. Value is what you get. That's a lesson my mentor, Ben Graham, taught me 70 years ago, and it's just as true today. The price to earnings ratio, PE ratio, it tells you how many dollars you're paying for every dollar of annual earnings the company generates. Let's say a company earns $5 per share, and the stock is trading at $100. That's a PE ratio of 20. You're paying $20 for every $1 of earnings. Now here's where it gets interesting. A low PE ratio might look like a bargain, but you have to ask, why is it low? Is the business dying? Is it in a terrible industry? Are earnings about to collapse? Sometimes a low PE is a value trap. It looks cheap, but it deserves to be cheap. On the other hand, a high PE ratio might be justified if the business is growing rapidly and has a long runway ahead. But you've got to be careful. When PE ratios get up into the 30s, 40s, 50s, you're paying for a lot of future growth, and the future is uncertain. Let me tell you what I look for. I want to buy wonderful businesses at reasonable prices. For most great companies, I'm comfortable paying a PE ratio in the mid-teens to low 20s. That's the sweet spot. If I can find a business with high return on equity, low debt, and a PE ratio under 20, I'm very, very interested. Now, the thing, you have to look at these 3 numbers together. They tell a story. Return on equity tells you if it's a good business. Debt to equity tells you if it's a safe business. Price to earnings tells you if it's a good deal. All 3 have to check out. If even one is off, I usually walk away. Let me walk you through a real-world example. Let's look at Coca-Cola when I bought it in 1988. Return on equity? Over 30%. Year after year after year. This business that took shareholders' money and turned it into more money with incredible efficiency. The brand was unbeatable. The distribution was global. The moat was a mile wide. Debt to equity? Low. Coca-Cola didn't need to borrow much. It generated so much cash from operations that it could fund growth, pay dividends, and still have money left over. Safe? Absolutely. Price to earnings? When I started buying, It was around 15. Not dirt cheap, but reasonable for a business of that quality. I wasn't trying to steal it. I was trying to buy a piece of a wonderful business at a fair price. All three numbers checked out, so I bought, and I held, and I held. That's the secret, by the way. Once you find a wonderful business at a fair price, you hold it. You let compound interest do the work. Our favorite holding period is forever. Now let me address something I know you're thinking. You're thinking, Warren, what about innovation? What about all these exciting new companies? Here's my answer. Growth is wonderful if it's profitable growth, but growth for the sake of growth is foolish. I've seen so many companies chase revenue without caring about profitability. They spend and spend and spend. They've story. The stock goes up, and then reality sets in. They can't make money. They burn through cash. The story falls apart. These three numbers keep you grounded in reality. Return on equity tells you if the growth is actually profitable. Debt to equity tells you if the growth is sustainable or if they're borrowing their way to disaster. Price to earnings tells you if the market has gotten way ahead of itself. Let me give you a counterexample. I famously passed on Google and Amazon. A lot of people have asked me about that over the years. And you know what? They're right to ask. I missed two of the greatest businesses of the last 25 years. Charlie jokes that I was sucking my thumb while the world changed around me. Why did I pass? Well, in the early days, both companies were growing like crazy, but they weren't yet generating the kinds of returns on equity that I look for. They were investing heavily. They were building infrastructure. And honestly, I didn't fully understand their business models. I stayed within my circle of competence, and tech was outside that circle. Now, does that mean my three-number test failed? No. It means I didn't apply it correctly. Or more honestly, I didn't see what those businesses would become. By the time they had the return on equity, the low debt, and the proven business model, the stock price had already run up. I was late. That's the thing about investing. You're going to miss opportunities. You're going to make mistakes. What matters is that you don't make catastrophic mistakes. You don't lose money permanently. Which brings me back to why these three numbers matter so much. They protect you. They keep you from chasing fads. They keep you from overpaying. They keep you from buying businesses that are going to blow up. They give you a margin of safety. Now, let me give you some practical advice on how to use this. First, don't look at just 1 year. Look at trends over 5 years, 10 years if you can. Is return on equity getting better or worse? Is debt going up or down? Are earnings growing consistently or bouncing all over the place? Second, compare the company to its competitors. If one company in an industry has a 25% return on equity and another has 8%, ask yourself why. What's the difference? That difference is the moat. Third, be patient. You don't have to swing at every pitch. In investing, unlike baseball, there are no called strikes. You can watch 100 pitches go by and wait for the one that's right in your sweet spot. Wait for the fat pitch. Wait for a company with high return on equity, low debt, and a reasonable PE ratio. When you find that combination, buy it and hold it. Let me tell you one more story before we wrap up. In the early 1990s, American Express got into trouble. There was a scandal involving one of their subsidiaries. The stock got hammered. People were scared. But I looked at the numbers. Return on equity, still strong. The core business, the card business, was unaffected. Debt, manageable. Price to earnings. Now it was cheap because everybody was panicking. I bought heavily. And sure enough, the scandal passed. The business recovered, and we made a lot of money. Be fearful when others are greedy, and greedy when others are fearful. That's what these three numbers let you do. When everyone else is panicking and the stock price is down, you can look at the fundamentals and ask, is this still a good business? If return on equity is still high, if debt is still low, then the price drop might be a gift. That's when you buy. Now, I want to be honest with you. These three numbers won't make you rich overnight. They won't help you pick the next hot stock that doubles in a month. That's not what this is about. This is about building wealth slowly, steadily, over decades. This is about not losing money. This is about compounding. Compound interest is the eighth wonder of the world. If you can earn 15 or 20% a year on your money consistently for 20 or 30 or 40 years, you will get very, very wealthy. Not by timing the market, not by trading in and out, by owning great businesses and letting them work for you. So here's my challenge to you. Before you buy your next stock, pull up the numbers. Look at return on equity over the last 10 years. Look at the debt to equity ratio right now. Look at the price to earnings ratio. Ask yourself, is this a wonderful business? Is it safe? Is the price reasonable? If the answer to all three is yes, you might have found something worth owning for a very long time. If the answer to any one is no, move on. There's always another opportunity. Let me close with this. Investing is not complicated. Wall Street wants you to think think it is, because if you knew how simple it was, you wouldn't need them. But the truth is, you can sit at your kitchen table, look at three numbers, and make decisions as good as any professional. You don't need a Bloomberg terminal. You don't need to watch CNBC all day. You don't need to trade constantly. You need to find wonderful businesses, buy them at fair prices, and hold them. That's it. That's the whole game. Return on equity, debt to equity, price to earnings. Three numbers, simple but powerful. I've used these three numbers to build Berkshire Hathaway into one of the largest companies in the world. I've used them to make myself and my shareholders a lot of money, and I'm telling you, you can use them too. Now, I'm not saying you'll never make a mistake. I've made plenty, but if you stick to these principles, if you stay disciplined, if you're patient, you will do well, you'll sleep well at night, you'll avoid catastrophic losses, and over time you'll build real wealth. So go ahead, pull up a stock you're interested in, look at the numbers, apply the test. And remember, you don't need to be brilliant, you just need to be disciplined. Thanks for listening. Now, if you'll excuse me, I've got about 500 pages left to read today, and I'm only 94, so I'd better get to it. And remember, if an old guy who eats McDonald's every morning and drinks Coca-Cola all day can figure this out, so can you.